Welcome back. Today we have a Bureau of Labor Statistics labor report coming out. And the expectations are as follows. We're expecting 200,000 jobs. The prior release was 261,000 jobs on the non-farm payrolls report. Private payrolls 185 expected, last was 233. Unemployment rate expected to stay stable at 3.7. And of course, the very important number, the month over month average hourly earnings change. The survey is 0.3. Let's see what happens. This is one of the remaining two reports before the Fed meeting, and it comes out within the next 5 seconds, and then we'll go on over to the docs. This will be big for the Fed meeting. It'll be one of the pieces. Here it is. Oh, wow. That's not good, actually. We got 263,000 jobs. The survey was 200,000. Unemployment rates, oh, God, yeah. Okay, not good. Average hourly earnings, terrible, coming in at 0.6. Not good. I'd expect red after this. Non-farm payrolls, again, coming in at 263 versus the 200,000 expected. So still strong labor report. So not a good labor report going into this. And that average hourly earnings move up to 0.6 is higher than the 0.4 we had before, higher than the 0.3 expected. The previous revision or the previous report was actually revised up in average hourly earnings from 0.4 to 0.5. The previous report did have a slight down revision in, actually, I'm sorry, reading that wrong. It had an up revision in the amount of jobs. And the prior report was at 261. We're at 284 now. So the prior report was revised up in average hourly earnings and the amount of earnings. And the actual release here does indicate still strong hiring. Again, coming in at 263,000 versus the 200,000 expectation. So hot on pretty much all accounts here. You're hot on the revision. You're hot on the inflationary number. You're hot on the total actual number here of jobs. Again, 263 versus 200 expected. This is a big deal because the Federal Reserve in their last meeting in November had none of these last four reports. That's the October CPI, the November CPI, the October jobs, and the November jobs numbers. These are now the November jobs numbers, and we have one report left to go, the CPI report coming out on the 13th of December, right before the 15th FOMC meeting. This is strong, this, and look at this, again, still sitting at leisure and hospitality. It's still that excess spending from, not only the holdup of people not having spent during the pandemic, but or traveled during the pandemic, but you're still seeing that explosion here in leisure and hospitality. Now, it is possible that's the last shoe to drop, but healthcare and government spending here as well. Employment declined in retail, trade, in transportation and warehousing. But yeah, it's still rough. Let's see, household survey measures labor force data. Okay, let's see what we have here. Household survey data. All right, unemployment rate unchanged at 3.7% in November and has been in a narrow range of 3.5 to 3.7% since March. Number of employed folks essentially unchanged. Unemployed folks essentially unchanged at 6 million. Among the major worker groups, you've got the various different unemployment rates here. White adult unemployment rate at 3.2%. The adult man, 3.4%, woman, 3.3%, blacks, 5.7%, Hispanics, 3.9%, Asians, 2.7%. Among the employed, number of permanent job losers rose by 127,000. Number of long-term unemployed relatively unchanged. Labor force participation rate at 62.1%, little changed from November. Okay. This definitely keeps some pressure on the Fed. Number of person employed part-time, 3.7 million. Not in the labor force was little changed at 5.6. Okay, so little changes in some of the other data. So here's that 263 bump in jobs right here, in line with average growth over the last 3 months. We're trying to see that come down, right? Average growth sitting at 282, trying to see that come down, reasonably here. It's not. I wonder how much of this is temporary, though. That would be very interesting to see how much of this is temporary for seasonal employment and how much of it is adjusted. In November, notable job gains occurred in leisure and hospitality. Leisure hospitality added 88,000 jobs in November, including 62,000 in food, services, and drinking places. Employment in hospitality, leisure is below its pre-pandemic February 2020 level. So here they're making the remark that, look, if a lot of these gains are coming in employment and hospitality, it's worth noting that we still are missing about a million jobs. And this is for, think airlines, for example. You just don't have enough people at the airport to help airlines move efficiently right now. In November, employment in healthcare rose by 45,000 with gains in ambulatory health services. Okay, here's some of the breakdowns of these. In November, other industry services rose 24,000. Fine. Local government, 32,000. Social assistance, 23,000. So that's government. Construction jobs continued an uptrend. I'm actually surprised that construction went up here. We were expecting to be negative in construction. Information rose 19,000. You've got actually a decent broad base of gains here. Now, I mean, these low levels of gains, though, isn't that terrible. It's not a bad thing to have these lower levels. What's bad is that average hourly earnings moving up 0.6%. That's high. That puts you at 7.2% for wage gains. 7.2% for wage gains. You compare that to inflation. It's almost where inflation is. You could be in approaching a wage style spiral. So not great. Not great. Employment showed a little change over the month. Average hourly earnings rose 0.6%. Yeah, not great at all. Average hourly work week for all employees on private non-farm payrolls declined to 34.4 hours. Man, I wish my average hourly work week was 34.4 hours. Average work week for all employees decreased to 40.2. Overtime declined to 3.1. Fine. All right. Anything else? Wow. No, that's let's get a little bit of reaction, but this is a little hot. We'll get both Bloomberg reaction and let's go ahead and pull a reaction here. Yeah, stock market definitely falling on this. The CPI report ultimately is the most important. And that CPI report comes out in 11 days. But it's not to minimize that, this is a problem. It's still a challenge to get employees, especially in leisure and hospitality. And that's what's driving the bulk of these gains. We saw that in the ADP report as well. Let's briefly listen in over here.
They are strong and they are higher. And that is what the Fed is going to be paying attention to. Jay Powell said it this week. Wages hold the key to inflation. And right now, wages are turning inflation up, not down. Even in the ADP data, we saw a little bit of an ease, but it's an ease from a really high level. Wage growth is still double digits from where it was last year before the pandemic. So we have to keep an eye on wages, but they're not going up for the great reasons you suggest, Joe, because of growth, because of productivity. Yeah. They're going up because of labor shortages, that people are still sitting on the sidelines, and that there is not enough labor to meet the demand in key sectors, those consumer-facing sectors that were hardest hit by the pandemic still.
Yeah, and that's what's so interesting. And it's not that you want to explain this away, because this is, not great. I mean, this is a report that as Bloomberg here says, upsets the dovish apple cart, right? And it shows that there's still so much hiring going on and so much strength in hiring that maybe things can't be that bad. But the question is, how long does that last? Going into November, and catching up with that hiring in restaurants and retail and travel. These are a big deal. I want to see, let's see here. Monthly revisions result from additional reports received from businesses and government agencies since the last published reports and the recalculation of seasonal factors. In accordance with the usual practice, the unemployment situation released for December 2022 is scheduled for Jan 6. Will incorporate annual revisions and seasonal data. It'd be interesting to see if we can grab the unadjusted report for this, because the adjustment for seasonal work would be very interesting. Part-time data and such, not seasonally adjusted. Here we go. Curious. So total. All right. Well, I'll keep poking around on this. Let me pull this quickly as well. So Bloomberg, obviously talking about, let's see here, 2 10-year yields rise more than 10 basis points. Average hourly earnings came in much higher than expected. Yes, they did. We have another very strong report. Yes, we do. We have... Okay. Give me one moment here. Let's go here for a moment.
Well, one thing is not in this report. I'm not seeing any of the layoffs that have been announced. I see pretty good strength in the information and tech sectors.
Right.
Also, Neela's report on Wednesday had a big decline in manufacturing, which is also in line with some of the ISM. And I think, if I'm not mistaken, Neela, you talked about the idea that maybe we're not capturing in this report what's happening now, but might in future months. I just would point out this is a very bad report for the Federal Reserve. It's going to prompt the Federal Reserve to do more. If you look at what's happened in the Fed funds futures markets, the peak rate has now surged. I think the last I looked, it was 12, 14 basis points just this morning, back up towards 5%. Right. It shows that people aren't listening to Powell. They're hearing what they want to hear. But let me just ask Neela.
By the way, that has been the story of the last
year. They hear what they want to hear.
See no evil, hear no evil.
Powell told you it was going to take a long time. And people are like, bye. Not to make fun of, but that was not a bye speech, okay, right. First of all. Yeah, but I want to ask Neela, your report, we give it a lot of respect. We don't quite know how to deal with it because you're only 3 months live with the new methodology. But this report today is not picking up a lot of the weakness we've heard from Challenger and job cuts, not picking up the layoffs we've heard about in tech, and not picking up some of the weakness that you have in your report. Do you want to respond to that?
Right. We're seeing interest rate sensitive sectors like manufacturing really feel the brunt of the Fed policy. It's not playing out in service sector yet, but it is playing out in goods producing sectors. And we continue to see that weakness. And I expect that will continue. Look, the problem with Fed policy now, when it comes to the housing market, which is where it's been most transparent, is it not only hits demand, it's hitting supply. You can see that in the home builders, which have basically came out and said that there is a housing recession because of higher financing costs. So you translate that through to not just housing, but all goods producing sectors that are dealing with higher input prices, as well as higher wage prices, higher labor costs. And you get some weakness there that is worth paying attention to, but it's being drowned out by the strength in the service sector.
I just make one more point just to Rick. Okay. Is what's happening in fixed income markets right now. That is what do you want to call it, an El Capitan face right now if you look at the 10-year, which is really reversing itself sharply.
I was going to ask Neela this, but I'll ask you, Rick. Is there any world, or what does a world look like where input costs are under control, a lot of things are under control?
Let's pull off this for a moment. Okay, so bonds moving on this a lot. A big move, 10 basis points. We're still down a lot. Financial conditions have definitely loosened. We're still sitting at 3.63%. That's substantial. That's where we were in August, September. Substantially lower than where we have been. So even though obviously the direction of the market movement here is clear, I think the market also realizes there could be some form of a lagging effect in this jobs report, especially given this 10 basis point jump in the 10-year treasury is not actually that much, and it's already kind of wearing away. Now it's under 10. Then it is very interesting to me that when we look for negatives, we see negative jobs here in areas of wholesale trade, retail trade, transportation and warehousing, temporary help services. This is a lot of where we're seeing that initial kind of, I feel like, layoff work, temporary help services, the information sector, but you still had more seasonally adjusted net hiring in tech over here. Yeah, but seasonally adjusted, where you are seeing the loss is that manufacturing and trade and temporary help. If I can get non-adjusted, be interesting, just because I feel like this post-pandemic era, making these adjustments is not exactly the easiest thing to do. And so that's why I'm trying to find not seasonally adjusted by category. What we have is here by sex, by veteran status. There we go. By occupation. Okay, got it. Not seasonally adjusted. These are the unemployment rates, employed. That doesn't give us a change. How interesting. I'd like to get a change. But anyway, yeah, look, strong report, no matter how you slice it. It's definitely something that's going to be something that adds that upward pressure to the Federal Reserve. Oh, I got it. Okay, here we go. So, no, again, this is the report I'm looking at here. I was really hoping there would be a section where it would give us a change in November, but it's just kind of giving us an aggregate total and it doesn't compare to the prior month. So I'll play with this a little bit. Maybe I'll try to get the last BLS report. But really what I'm looking for is here's the unadjusted change. And for example, in information, I mean, we could do it really quick. In information, we're sitting at, what do we have here? We're at 57,000 in thousands, okay? So number of unemployed, well, yeah, it's unemployed anyway. But I mean, we could look at that as relative to the other report. All right, BLS report, October. We'll do that really quick. I'll pull that up. While we pull that up, let's take a listen in over here.
Sarah, Betsy, Tyler, raise your hand. Who wants to weigh in on all this? Because we've said a lot.
Yeah. I'll say that this is a disappointing number when it comes to inflation, because people have been hoping that goods and shelter prices would start to show a rollover. What we're learning is that wages are sticky. But the key risk for us for 2023 is really that recession risk. And how do you build recession resilient portfolios? Just from an investing point of view, you look for quality. You look for companies that are growing their dividends, companies in the infrastructure space that are backed up by utilities and waste management. Outside of publics, you can look at private credit that tends to be more resilient in the downturn. And fixed income, I know it looks tough today, but we still do think a lot of the pain is priced in. You can get equity-like returns out of fixed income, high-quality investment-grade portfolios.
It just is a dismal science, Betsy, that it's like the economy's not cooperating, going into a recession. What do we got to do? I mean, it's just a dismal way to do things.
Yeah, I think that's a good one to hit it on there. It's definitely not the report you're looking for, especially it looks like the majority of the jobs were concentrated in services. You're sitting at 184,000 jobs last month. And the employment jobs report provides another dose of reality for the markets, which have gotten ahead of themselves on another Fed pivot narrative. Yeah, well, we'll see. We'll see how lagging the jobs report is, because after that shift in the yield curves and Powell a few days ago, I think the looking forward is a little more important than the looking backward. But we'll see how Powell ends up explaining this away in 13 days. I'm sorry, in 11 days, or maybe he doesn't. But in the meantime, markets will be a little tentative on this. And I expect some quietness going into CPI, the CPI read anyway. Like I personally wouldn't be going for big call options between now and the CPI meet. And really, it's interesting that rally there in bonds for a moment is let's see here. Hold on. Yields were as high as 0.13 to the upside for a moment. You've already lost half of that. You're at 0.08 now. Now you're sitting at a 10-year of 3.6. When it comes to stocks, not seeing as much of a recovery on tech. You're seeing a negative. Yeah, we went down about 2.5%. Now we're sitting at about 2.01. S&P. sitting at about negative 1.46. These stocks sitting a little lower, but those yields are evaporating, those yield gains, which could be a way of the market, at least the bond market, indicating, yeah, look at, I mean, they're just evaporating. It could be a way of the bond market saying, no, you know what, we get it. This is backward looking, seasonally adjusted or not. We realize there's still a shortage of workers. I think the biggest bullish piece out of this entire report, if you were looking to be bullish, because it's a bearish report, okay, I'm not trying to make light of that, but if you were looking for something bullish, a rationale, it's right here, because this report tells you that, look, yeah, we're still gaining in jobs, but we're also well underemployed in leisure and hospitality by the tune of 1 million jobs. That, just to get to where we were in 2019, could literally be another 12 more months of high job gains in leisure and hospitality to get back to a level where we were 3 years ago. That's insane. I mean, think about that for a moment. Usually we have more employment in leisure and hospitality over time. Just to get to break even from 3 years ago, we probably have another year worth of high job gains in this sector. But, you know, this is that potential bullishness is offset by this issue of, well, wait a minute though. Why are we seeing manufacturing come in at plus 12,000 or plus 14,000 when the ADP report was negative? Yeah, well, the ADP report is like always wrong. You know, sometimes it gives you a trend, but here you go, it's wrong again. But it's another measure, it's another survey, and at least if it starts showing cracks, maybe those cracks will start showing up here, but not yet. So that's a little bit disappointing, as well as the information and technology side. So I'm going to pay close attention personally to the change in yields, which honestly is evaporating. Again, now it's just sitting at 0.063. What I would do if I were you is I would watch this number right here to the end of the day, because again, this jobs report was rough. This was a very strong jobs report coming in at 263 versus an estimate of 200,000, and an upward revision in the past, and an average boost of hourly earnings to 0.6 versus the expectation of 0.3. Or the last of 0.4, which got revised up to 0.5. Not good. Not good. So I'm going to be watching that yield curve and look at it again, plummeting. And so I find it very, very interesting. Let's actually click on this. That despite this strong report here, we're seeing yields on the day. We should see a spike and a plummet. Let's see here. I don't think it gives us the day chart this early. No, it doesn't. It doesn't get, CNBC doesn't give us the day chart this early, but you would expect to see some form of a large spike, you know, somewhere around 15 basis points. And we've almost gotten rid of all of that. And I think the bond market is looking through this. The stock market is not yet, though. Okay, let's see here. If there is any change yet that we could see, it would be interesting. In the terminal rate expectations and the expectations for a rate hike next in 2 weeks from now, we shouldn't really see any big change. Yeah, okay, well, I mean, nominal change here. Odds of a 50 basis point hike now sitting at 71% versus 80% yesterday. We were at 19% for a 75 BP hike. That's now sitting at about 29%. And terminal rate, do we have an update on the terminal rate? Terminal rate, yeah, Fed terminal rate popped a little bit. Yesterday we were down to just about 5. Now we're back to about 5.12 in expectations. And let's see if we can get the 5-year break even and update. Five-year break even, rotating down a little bit under 2.5, sitting at 2.49. So, yeah, look, and then you do have two surveys here, right? You have the household survey and you have the regular establishment survey. The household surveys has been coming in weak. time after time. It's not your headline data that we pay attention to a lot, but it's gonna be interesting. Let me see if I can compare it to last quickly. No. All right. Anyway, yeah, not the best. I would personally say watch the bond market. Look at that. Almost. I mean, this. I'm having entertainment watching this. Almost all of the gains on the 10-year are gone after this report. Almost all of it gone. Look at that. We're at 3 basis points now on the 10-year, and then we're flat with yesterday, which these plummeted yesterday. And sure enough, look what's happening. The bond market is explaining this away, and the stock market's coming back. It's really interesting. This is, I think people are looking through this report. They realize this one bullish aspect, and there really is only one bullish aspect. That's this box right there, and that's it. So we'll pay attention to that. Anyway, all right, folks, thanks so much for being here. We'll see you in the next one. Appreciate y'all. Bye.